Many high-income earners operate under the assumption that their tax liability is largely fixed. In reality, there are specific IRS-recognized strategies that, when properly structured, can materially change that outcome. One of the more effective strategies in today's environment is the short-term rental exception. Under standard tax rules, rental real estate is generally treated as a passive activity. This means that any losses generated by the property typically cannot be used to offset active income, such as W-2 wages or business earnings. However, an exception exists for qualifying short-term rentals. If a property maintains an average guest stay of 7 days or less, and the owner meets material participation requirements, generally around 100 hours and more than any other individual involved, the activity may be reclassified as non-passive. This distinction is significant. Once classified as non-passive, losses generated from the property, primarily through accelerated depreciation, may be applied against active income. These losses are typically created through a cost segregation study, which identifies components of the property that can be depreciated over shorter timeframes. When combined with current bonus depreciation rules, this can result in substantial first-year paper losses. When properly executed, this creates the potential for a meaningful reduction in taxable income. It's important to note that this is not a passive strategy. It requires a structured approach that includes acquiring the right property, completing defined participation activities, and maintaining proper documentation throughout the process. In many cases, the short-term rental use is temporary, allowing the owner to meet participation requirements, establish non-passive classification, and capture the tax benefits before transitioning the property into a more passive long-term hold. DFY provides a comprehensive framework to support the execution of this strategy. This includes sourcing and delivering properties aligned with both performance and compliance considerations, providing guidance on material participation, and offering systems for tracking, documentation, and overall implementation. The result is a structured and organized approach to a strategy that would otherwise be complex to execute independently. When all elements are aligned, the short-term rental exception represents a defined, compliant method of leveraging real estate to create both tax efficiency and long-term asset ownership.